So I think I want to set the stage by pointing three things which I think we should all think about as allocators and investors in this room. First one is if you look back in time, the last 80 years, we've had this unipolar world where we had a single hegemon, the United States, which decided trade policy, portfolio flows, security arrangements, everything was decided by the single hegemon. I think we're moving from that single hegemon to a multipolar world where the Far East is going to be dominated by China. China kind of considers all of that as its own backyard. Europe is a contested territory between the Russians and the Germans, and eventually that conflict there will get resolved. And so what it means from an investing point of view is that it's no longer sufficient for us to think about geographical diversification. So it doesn't make sense to say, oh, I have a little bit of European equities and Japanese equities and kind of diversified. Because the multipolar world means that the legal systems and the arrangements that we have and we've taken for granted may not exist anymore. So to give you a recent example, you all remember when we had a bunch of Russian ADRs that were listed in New York, and what happened to it when Russia invaded Ukraine, right? So investment now, we need to take into consideration more factors than simple kind of construct like geographical diversification and country diversification. That's my first theme. The second idea is if you take the last 30 years of financial markets, the Federal Reserve has been the main game in town. It's monetary policy, dominated discussions. All of us spent enormous amounts of time trying to divine what the Fed was going to do, the dot plots, Fed speeches, all of that stuff. I think we've now moved from a world where monetary policy is the dominant driver to a world where fiscal policy is the dominant driver. So what does that mean for us? Well, it matters more what our Treasury Secretary has to say than what Fed Chairman Powell has to say. And that's not just here. If you look across the world, central banks have less to do in this world where fiscal policy is becoming a constraint, right? Most of the world, we are getting to the point where public debt is getting to a point where the financing of the debt is becoming a very big part of GDP. So the second idea that I want to propose is we need to think about how do we invest in a world where fiscal policy is the constraint and the Treasury secretaries and the finance ministers are the ones that we should listen to. The last one, and this is the most controversial one, is I know this is a room full of people using AI, and we were talking about how AI is a big enabler, and I'm using AI as well. But the thing to think about in terms of AI is that in order for AI to kind of develop and blossom, we need a lot of energy, and we are energy rich. We are energy poor, compute rich. The Chinese are energy rich, compute poor, right? So what does that mean from an investment point of view? If you look at the performance of equity markets over the last 2 decades, software has been the predominant driver of returns, right? Like you look at the S&P 500, 50% of the index is now software and technology companies. So if we are going into a world where bits are not as important and atoms are more important, and that's the constraint, we need to be investing more in atoms, right? Which is energy, copper, rare earth, all of this stuff. So that's my third thematic sort of idea for the next few years.